What is futures? Futures contracts originated in the Chicago Board of Trade in the United States in 1865. Give an example to illustrate the concept of futures. John's family has been farming for generations. Many fruits are grown at home, and they are sold to mid-market traders when they are harvested. However, due to unstable weather, the purchase price of mid-sellers also changes from time to time. As long as the weather is good and the fruit grows well, the mid-market business is willing to buy it at a high price of $100. But if the weather is bad and the fruit looks ugly, the mid-market business is only willing to buy it at a low price of $80. One day John thought, instead of deciding the price every year based on the weather, why don't I sign a contract with the mid-market at the beginning of the year? Discuss that after the fruit is harvested at the end of the year, buy and sell at a price acceptable to each other. Let's say it's $90. The advantage to John is that he can avoid the risk that the fruit will not be sold if the weather is bad. The advantage for mid-market traders is that price stability is also more secure for future planning. So the two parties each paid a deposit and signed a future sale and purchase agreement for the fruit. This agreement is the structure of futures. The development of futures has not only involved buyers and sellers. In the market, many investors are keen to participate in the trading of these futures contracts. It is also because it is only buying and selling futures contracts, not actually signing physical futures, so it will not involve the buying and selling of real goods. The profit and loss of both parties are only the contract price difference. The characteristics of futures trading. 1. Futures trading costs are low. The transaction cost of futures is lower than that of stocks and ETF. In terms of transaction costs, the total transaction cost of buying and selling futures is about 1/30th of the ETF and 1/50th of the stock. 2. Futures are highly flexible and can be long and short. Regardless of whether the futures is long or short, the requirements are the same. As long as there is a futures account, it can be done. In other words, as long as the direction is right, investors will have the opportunity to profit no matter if it is long or short. 3. Futures can be leveraged, and the use of funds is flexible. When you first come into contact with futures, it is recommended not to use too high leverage. After you have a certain amount of trading experience, you will gradually increase your trading leverage. The delivery method of futures. Because the nature of futures is still a contract, there will be a settlement date. This part needs to be paid attention to when buying and selling, because when the settlement date is reached, no matter whether it is making money or losing money on the account, it will be executed by the dealer in accordance with their settlement method. There are two common execution methods. 1. The futures dealer will automatically help you roll over to a new contract. The intermediate profit and loss will be deducted or compensated in the name of extension fee, inventory fee, etc. For example, your crude oil contract price in April is $20, and the price in May is $15. After the futures dealer helps you extend the new contracts to May, although the book shows a loss of $5. But the $5 will be paid back to your account in other forms. 2. The futures contract expires, helping you to passively close your position. For example, your crude oil contract price in April is $20, and the price in May is $25. The broker will close your position on the delivery day. If it is a long position, it will exit the market with a stop profit of $25, and a short order will exit the market with a stop loss of $25. Therefore, if you have a futures position, pay attention to when the settlement date is. Usually the settlement date and method can be found on the trading page of the futures dealer or on the official website.